These are not necessarily bank runs. This is very different. So this is only available to the semi-liquid funds, which is a small portion of the private credit that the managers operate. The largest 8 managers operate almost $1 trillion of private credit.
Nice.
Half of it is actually the insurance money.
Yep.
So these funds, and we published a note on this about a week ago, are only about 5% of their private credit business, less than 3% of the overall total. So that's where the clients, this is more retail products designed for family offices and smaller investors, where clients can take out the money. So that's only the portion.
Do we know who exactly is requesting these redemptions? I mean, you talk about family offices and retail investors, but are retail investors that big a client base of some of these private credit funds?
It is a big client base. It's also approaching $1 trillion, but it's spread out over different products, not just private credit, it's private equity, real estate. There are many different products. We're hearing anecdotally some things, some very small investors. Yes, we've heard from Ares this morning that supposedly those are some of the family offices, a handful of them.
These are sophisticated investors who understood that there was a lockup, right?
Absolutely. Absolutely, they should have. I think a lot of people are saying, look at the small print that you can only take out 5% per quarter. I just printed out the Ares Strategic Fund, just for a fact sheet. It's one of the bullets on the front page in bold. So these people should understand it.
We all saw this coming. We said, once you let retail in, that's fine. It's a great new pool of money for the private equity guy, private credit managers to tap. But now you got to deal with retail mom and pop, and that's going to be a hassle. And boom, here we go.
It is very true, and it's kind of a self-fulfilling prophecy. If you know exactly that you can only take 5%, and you're going to be prorated based on what the fund requests are, and you're in 3 or 4 different funds, you're going to request from all of them, regardless what's in them.
All right, so bigger picture, do you feel like there's a credit quality concern in private credit broadly defined, whether it's limited to software companies or other areas?
I believe there is some. Well, there is obviously some to a large extent, but not very much different necessarily what could be done by the banks. Yep. There is some concern that there's less transparency in the private credit, although these kind of BDC companies that we've seen, those semi-liquid funds, they've actually do monthly mark-to-market. So we've seen Ares, we've seen BCRED, the big Blackstone fund. They were down. They already reported to be down several percent on the mark-to-market. So there is some transparency. Certain areas have more exposure to software, like the BDC companies, where some of them go up to 20+% in the software segment. But if you look at the overall manager, that's typically in single digits.
What's the best way to respond to these redemption requests? I mean, some of these firms have limited or capped their withdrawal at exactly what the preset level was. Others have, basically allowed for more redemptions than what they had set out to do. I mean, does one engender more confidence or, generate more concern than the other? What's the preferred response?
I think it's a little bit hard to define. We've seen 3 firms like Blackstone, Blue Owl, and Cliffwater paying out a little bit more than 5%. The bulk of the other firms are capping their redemptions at 5%. I don't think it's necessarily about the sentiment, but I think that those that are staying within 5% are probably playing it safer. Because if we remember several years ago when there was a lot of redemption requests from a BREIT, the real estate fund that Blackstone operates, it took several quarters for the redemption to balance out. So you kind of suggested one quarter, the next quarter it's going to be much more difficult to do.
If I went to go out and raise a private credit fund today, can I do that?
You probably can. You can go to institutional investors. And when the company is going to report next month, we're probably still going to see some private credit money coming in, but it's definitely going to be a lot
How about
more
a retail-oriented BDC? Remind me what that stands for again? Business
development company.
BDC. Yeah. Could I do a big BDC?
Well, the BDCs are sold. If you are publicly traded, you're traded on the market.
Okay.
If you're private, you are distributed through the financial advisors.
Okay.
You're a financial advisor and calling your client who's seeing all these headlines, it's going to be very hard to sell something right now.
So, Paul, you don't sound very worried. You sound pretty calm about this. What would make you worry?
More systemic issues. And the systemic issues, I'm talking about a real credit cycle. which we haven't probably seen in almost 20 years.
Yeah, it feels like it's been. What is a what is a credit cycle at this point?
I mean, you do see delinquencies increasing, and it's been happening for a number of quarters now, not just in the BDCs, but also we've seen a little bit from the banks.
But nothing that's changed the overall tenor and overall demand for credit.
So the economy is doing okay, the GDP is doing okay, the unemployment is doing okay, the major drivers of the serious credit cycle is there, and the liquidity is there. A lot of the credit cycles are started through the liquidity problems. Liquidity is still there.